Marin Katusa is out with a new stock teaser claiming certain AI stocks will gain 1,000%. In total, he's pitching 3 AI kill switch stocks, and I reveal all 3 of them in this video, based on the clues in the presentation, saving you nearly $2,000 in total. Before I reveal the stocks, I want to look at Marin's past stock picks, so you have an idea at how good he is at picking stocks. In December 2020, Marin recommended 3 gold stocks as rebound stocks from COVID. The first of these stocks was Equinox Gold, and the stock has performed badly since being recommended and is down overall. The second gold stock was First Mining Gold, and this stock has done horribly as well. Goldterra was the last stock being recommended by Marin, and the stock was the worst of all 3, and has lost most of its value. In May 2021, Marin recommended Carbon Streaming Corp as a play on the push to reduce carbon emissions. The stock briefly doubled shortly after being recommended, but has since lost the majority of its value. In March 2023, Marin recommended another gold stock called Osisko Development. This is another stinker and has lost around 50% of its value since being recommended. If you appreciate me shining some light on Marin's stock picking history, make sure to drop a like and subscribe for more videos like this in the future. Let's start revealing the stocks from the AI kill switch teaser now. The first stock has to do with nuclear, which many stock pickers are claiming will enable AI to take off. AI uses a ton of energy, and Marin claims nuclear will be the energy source to fix this problem. Unlike many other stock pickers, though, Marin isn't recommending a nuclear company or a small modular reactor company. Instead, he's recommending a uranium mining company called Uranium Energy Corp. Uranium Energy Corp, ticker symbol UEC, is a US-based uranium mining and exploration company. The company has been focusing on leveraging the increasing demand for uranium as the world shifts towards cleaner energy sources. With the growing interest in nuclear power as a viable alternative to fossil fuels, UEC is positioned to benefit significantly. As of the latest data, Uranium Energy Corp is trading at around $6.75 per share, growing over 100% in the last year. This uptick can be attributed to several key factors. Firstly, the company has been actively expanding its asset base. Recently, UEC acquired Uranium One Americas, which has added substantial resources to its already rich portfolio. This acquisition is a strategic move, enhancing UEC's position as a leading uranium producer in the United States. Financially, UEC has been solidifying its standing. The company reported a revenue increase of 30% in its latest quarterly results, driven by the higher uranium prices and increased production volumes. UEC's cash position remains strong, with over $100 million in cash and liquid assets, giving it a robust financial cushion to weather market fluctuations and invest in further growth opportunities. One of the most compelling aspects of Uranium Energy Corp is its low-cost production strategy. By employing in-situ recovery mining technology, UEC can extract uranium more efficiently and at a lower cost compared to traditional mining methods. This advantage not only makes the company more competitive, but also more profitable as uranium prices continue to rise. The global uranium market is experiencing a resurgence, with prices climbing steadily due to increased demand from nuclear power plants and a push towards reducing carbon emissions. This trend bodes well for UEC, as it is poised to capitalize on these favorable market conditions. Analysts are optimistic about the company's future, with several upgrading their price targets for UEC stock. The consensus is that UEC could see its stock price climb to over $7 per share within the next 12 months, representing a potential upside of nearly 13%. In terms of growth potential, UEC is also exploring opportunities beyond the US market. The company has projects in Paraguay and Canada, which could provide additional revenue streams and further bolster its market position. These international ventures are still in the early stages, but they demonstrate UEC's commitment to becoming a global player in the uranium industry. In conclusion, Uranium Energy Corp stands out as a compelling investment opportunity in the energy sector. With its strong financials, strategic acquisitions, efficient production methods, and favorable market conditions, UEC is well positioned for continued growth. As always, investing in stocks involves risks, so it's important to do your own research and consider your financial goals before making any investment decisions. If you're looking for a stock with solid potential in the clean energy space, Uranium Energy Corp is definitely worth keeping an eye on. I'm going to reveal the next 2 stocks in the next section, but before I do that, I want to remind you to click the link in the description to check out Insider Newsletter. I've reviewed over 100 stock picking services, and Insider Newsletter gets the best returns, and for a limited time, it's only $1 to try. The next stock is another energy stock, but focuses on natural gas and oil this time. Marin is pitching Enbridge, which builds oil and gas pipelines. Enbridge, trading under the ticker symbol ENB, is a major player in the energy industry, with a vast network of pipelines that transport crude oil, natural gas, and other petroleum products. The company also operates natural gas distribution utilities and has a growing presence in renewable energy. Enbridge's diversified portfolio and strategic positioning make it a compelling investment option. As of the latest data, Enbridge is trading at around $36 per share, offering a dividend yield of over 7.2%. This high yield is one of the key attractions for investors seeking regular income. Enbridge has a solid track record of dividend growth, having increased its dividend for 26 consecutive years. The company's commitment to returning value to shareholders is evident in its robust dividend policy. Financially, Enbridge has been performing well. In its most recent quarterly results, the company reported a revenue of $10.3 billion, reflecting a 12% year-over-year increase. Enbridge's earnings per share came in at 68 cents, exceeding analysts' expectations. This positive performance is driven by the strong demand for energy transportation and the company's ability to efficiently manage its operations. One of the significant factors contributing to Enbridge's stability is its regulated pipeline business. The majority of Enbridge's earnings come from long-term contracts and fee-based revenue, which provides predictable cash flows. This stability is particularly appealing in the volatile energy market, offering investors a degree of certainty regarding future income. Enbridge is also making significant strides in the renewable energy sector. The company has invested in several wind, solar, and geothermal projects, aiming to diversify its energy sources and reduce its carbon footprint. Currently, Enbridge has over 3,000 megawatts of net renewable generating capacity, positioning itself as a leader in the transition to cleaner energy. This commitment to sustainability is likely to attract environmentally conscious investors and support long-term growth. Looking ahead, Enbridge has several growth projects in the pipeline. The company plans to invest approximately $10 billion in capital projects over the next 3 years, focusing on expanding its natural gas and liquids infrastructure, as well as renewable energy assets. These investments are expected to drive future earnings growth and enhance Enbridge's competitive edge in the energy sector. Analysts are optimistic about Enbridge's future prospects, with many maintaining a buy rating on the stock. The consensus price target for Enbridge is around 56 per share, suggesting a potential upside of over 50% from its current level. Combined with its attractive dividend yield, Enbridge offers a compelling total return potential for investors. However, it's important to consider the risks associated with investing in Enbridge. The energy sector is subject to regulatory changes, environmental concerns, and fluctuations in commodity prices. While Enbridge's stable business model mitigates some of these risks, investors should remain aware of the broader market conditions. The last stock Marin describes as the landlord of AI. He's talking about a REIT that owns data centers. However, Marin doesn't really leave enough clues to figure out which one in particular he's talking about, but he's likely hinting at Digital Realty or Equinix. Both of these companies are pure play investments in data center REITs. Both of these companies are very large and may have trouble growing in the future. Both also have dividends of over 2%. And if you really want to make money with the stock market, make sure to click the link in the description to check out Insider Newsletter. I've reviewed hundreds of stock picking newsletters, and Insider Newsletter performs the best by far. On top of this, it's only $1 to try. So again, click the link in the description to check out this newsletter.